The case for SCHD. Why dividend investors love SCHD. Hey, how goes it? Welcome back to Dividend Compounders with Cheese. I'll be transparent with you. I'm not the biggest fan of SCHD, but I think it's important for people to have their beliefs challenged every so often to confirm their views or to learn something new, or at least gain a new perspective. It's never wise to be in an echo chamber or seek information that yields confirmation bias. It's healthy to be exposed to contrarian ideas and opposing talking points. So let's see if by the end of this video, will I become a fan of SCHD? Ooh, a cliffhanger. I actually made a video on why you shouldn't invest in SCHD because I'm a hater. And it was during that research I started to think SCHD might not be so bad for a dividend investor. It's like I'm playing good cop and bad cop. First, it's why we shouldn't. And now in this video, we are going to talk about why dividend investors love SCHD. Even just saying that, it sounds like a healthy superfood like kimchi or spinach, something a cult member would praise to the highest. We all worship SCHD. And yes, lately, as I have been growing older, the color orange has grown on me, which explains the backdrop of the slideshow and the thumbnails of my videos. So reason number one, the dividend profile is great. SCHD has a good payout ratio, good dividend growth, and decent dividend yield at 3.65%. They increase their dividends by 5.7% annually on average. This is so important and awesome to see. Reason number two, it is most definitely a dividend compounder with cheese. Let's look at the average dividend growth rate come into play, and you'll see why it is so important. SCHD back in 2013 paid 90 cents for its annual dividend payout. And as you fast forward throughout the years, they have been consistently increasing that dividend payment because they have been growing at 5.7% annually. And now, as of last year, the average dividend payout is $2.56. 2013 was 90 cents. Last year was $2.56. And remember, that was just the dividends. The CAGR, which is the compound annual growth rate when you take into consideration the dividends and the capital appreciation of the stock, has been 10.6% on average every year since 2011, which is when the ETF was born. The total returns is 320% since 2011. And of course, right here, the average dividend growth rate, 5.7% year over year. Now let's look at the capital appreciation as well. So back in October of 2011, it looks like SCHD was trading roughly at about $25 per share. And since then, it's just been growing at a tremendous rate. And then of course, during the pandemic sell-off, it did hit a low of $40 per share. But since then, it has recovered. Today, SCHD is trading at about $72 per share, plus or minus a dollar or two. Back in 2011, $25 a share. Now it's $72 per share. This is one of those moments where if you knew it was going to be this successful, you would have done it. If you had put $1,000 into SCHD back in November of 2011, that $1,000 would have grown to $4,011.33 today. My most favorite burger in the world is the dividend compounder with cheese, and SCHD is looking like it. And reason number three, SCHD has a very low cost expense ratio of 0.06%. Some ETFs charge fees like 1%, meaning for every $10,000 you earn, the fund takes away $100 as a maintenance fee. It takes away from your gains. Imagine if someone were to only give you a half portion of mac and cheese at Thanksgiving dinner. You'd be pissed. Well, why invest in ETFs that have very high expense ratios? Just look at some of these fees. Outrageous. Using that same example, for every $10,000 that you earn with SCHD, they take $6. That's absolutely doable. You spend $6 without hesitation when you order a drink when eating out. So what's $6, right? And moving right along, reason number four is the management team. Put time back into your hands because you can trust the Charles Schwab fund managers to do their job and to rotate bad companies out of SCHD and replace them with good companies. Let them do the due diligence and all of the work. You only need faith, hope, and your money invested into SCHD. Make investing as passive as possible. All you have to do is just sit back and let the passive income roll in. Mr. Juwono has been a part of the SCHD team since its inception, 2011. And reason number five, the screening criteria criteria for inclusion into the SCHD portfolio. The fund managers are not just chasing a dividend yield and adding random stocks. They have a list they go through to evaluate a potential stock, which include number 1, at least 10 consecutive years of dividend payments. Number 2, minimum of a $500 million market cap. And number 3, they measure success of the company by its cash flow to total debt, return on equity, dividend yield, and a 5-year consecutive dividend growth rate. That's how they determine whether it is a quality company or not. And number 4, they select the 100 highest yielding stocks among the universe of qualifying components. If any one of those stocks change for the worse, they replace it with another stock. And number 5, the fund also puts a 4.5% weight cap on any individual component and a 25% weight cap on any sector in order to help ensure diversification. This prevents the portfolio from being overexposed to one stock, like having 50% of the portfolio in Apple or 50% of it being in technology. Moving right along, did I become a fan of SCHD? The answer may surprise you. With that said, I personally wouldn't invest in SCHD right now because ETFs are just not my thing. However, if I had to pick an ETF, I wouldn't, but if I had to, I'd go with Vanguard's VTI or VU. As a matter of fact, I think for most people, they're better off investing in VTI and calling it a day. Why do I prefer VU? I like the evaluation and criteria metrics of the S&P 500, and as for VTI, well, at that point, it's more so believing in the American economy and businesses thriving rather than being knowledgeable about every single company within the portfolio. As for me, I'm going to be taking my chances on trying to only invest in high quality companies with economic advantages while avoiding the losers, because in an ETF, you get a mixed bag. This is absolutely much easier said than done, but I love learning and I'm always reading to gain more knowledge about anything and everything. That's the type of person that I am. So when it comes to investing, is it a surprise that I enjoy researching companies when I have a pleasant experience or am a fan of their product? I genuinely enjoy analyzing and doing deep dives on company profiles to figure out if their forecast and future are the winners within SCHD or VU. Here is my caveat. If I was giving advice to my dog, I would tell him, you only need 3 holdings in your portfolio, and all you have to do is put money into your brokerage account bi-weekly or even monthly. Those 3 holdings would be VTI, VU, and SCHD. I think after doing my research, I like what I am seeing with SCHD. SCHD is that hot girl at school that everybody wants to date, and I just feel like that's one of the factors as to why I continue to be a hater. But in the end, I think I am a fan of SCHD. I like it. However, right now, I'm still doing individual stocks for the time being, but eventually when I do move on to ETFs, SCHD is at the top of my list for sure. It's definitely a top tier ETF, and I can see why there is an SCHD cult that is passionate the way they are. Maybe one day I'll even convert. Jeez, this sounds like a religion. We shall see. Anyways, stay safe and I'll talk to you next time. Dividend Compounders with Cheese, signing out.